Don't be the fool that ignores the important data. Over here, we've got the exchange flows for Bitcoin. This is data we cannot get in any other market. In traditional finance, in stocks, we don't know how capital flows are organized. But on the blockchain, we can see everything. When Bitcoin move into exchanges, we tend to see the price falling. When it gets withdrawn from exchanges, we tend to see the price rising. And this makes sense. People move their Bitcoin on exchanges in order to subsequently sell it. And they move it off the exchanges in order to hold it long term. This is an important indicator. And we can see that recently it's close to getting to green again, as in the long-term traders might start accumulating Bitcoin again instead of sending it to the exchanges. Now, who is accumulating? What we see over here are different wallet cohorts segregated by their size. And then in colors, we see if that particular wallet cohort is currently accumulating or rather distributing Bitcoin. At the bottom, we've got all the wallets that have less than 1 Bitcoin. Then we've got 1 to 10 Bitcoin, etc. It goes up 1 order of magnitude every time. At the top are the whales. At the bottom are the regular retail investors. When this is blue, we see accumulation. When this is red, we see distribution. And we can see that the recent dip was especially bought by the smaller wallets. Every time Bitcoin drops, we see accumulation by the smaller wallets. It happened over here, it happened over here, it also happened over here. The whale wallets have much less correlation to the price. They are currently acquiring again and potentially helping the price development. The small retail investor has stopped buying. Those capital flows that happen on chain are much more important compared to, say, the ETFs, compared to what Wall Street is doing. Because the ETFs, they only hold roughly 5% of Bitcoin supply. The treasury companies, so let's say Michael Saylor's strategy, holds another 5%. So we've got 10% with Wall Street, the other 90% is on chain. And so while data like this is interesting, it might not be the most predictive of what's going to happen with Bitcoin. This is the US spot ETF flows. Yes, they stopped selling recently. They rather start to slightly accumulate again. But have a look at how much impact that has. This is a different way to look at those ETF flows. This is, though, how that compares to the realized cap change. So what are actually long-term holders doing? Are they currently locking in profit or are they realizing losses? Currently on average they are realizing losses, and the magnitude of those movements is much larger compared to the magnitude of the ETF flows. This is a chart I keep repeating on many videos on this channel. It's the realized price and it's the North Star for my personal Bitcoin allocation. Whenever the current price is below the realized price, then the average Bitcoin investor is in net unrealized losses. Whenever we are above, then of course we are in net unrealized gains. Why does this matter? It matters because the psychology of Bitcoin is pretty much the same that we see with the psychology of any investment market. Let's say you buy a house for investment. You buy that house for a certain price. And then we see a crash, right? We see how all property prices go down. You will only sell the house if you're incredibly scared or if you have to sell. But if you're long-term bullish on property, because property tends to appreciate long-term, or in other words, the fiat currency tends to devalue over time. If you're long-term bullish on property, you will not sell at a loss. You will wait until you personally are in gains, in profit, and then you might realize some of that profit. But you won't necessarily realize losses if you don't have to due to personal reasons. And that's the same with Bitcoin. Long-term, Bitcoin appreciates just like property because the supply is limited, but the demand is not measured in fiat currency because fiat currency goes up over time, right? The supply grows by 6.8% for the US dollar. So long-term, measured in US dollars, property or Bitcoin has to go up. If you bought Bitcoin for a higher price than where it is right now, you just tend to keep on holding, and maybe you're even allocating more towards the asset. The reason why the realized price is so useful because it shows that psychological anchor point of the average entry for the average Bitcoin investor. In the past, we had to be in unrealized losses until the selling pressure waned, until we actually saw the bear market turning around. That's currently at $53,000. This is then how the net unrealized profit and loss looks like over time. Again, we are not yet in the losses. Now, just because I think that Bitcoin has more room to fall doesn't mean that I'm now allocating everything towards artificial intelligence stocks. Rather the opposite. I'm even more bearish on AI. And it's not because I'm bearish all the time. It's simply just looking at relative valuations again. The official narrative is that Bitcoin and tech stocks tend to move in the same direction at the same time. And while this did hold for a while, for example here this was COVID, then we also topped out at similar levels, we bottomed out at similar levels, that correlation has now weakened massively. We got our new all-time highs in technology stocks, yet Bitcoin fell by 50%. So where does this decoupling come from? Again, I think it's mainly the volatility. It's mainly because Bitcoin has outperformed that much and people realize their profit until they don't anymore, until there is no profit to realize. This here is Bitcoin relative to technology stocks. So we look at the Bitcoin price and we divide it by the Nasdaq 100. And there's no surprise here. Long term, there is diminishing returns for Bitcoin. And if we are very unlucky, we might even see long-term underperformance. We've already seen extremely small marginal outperformance from one cycle peak to the next. That was from 2021 to 2025, an outperformance of only 10%. But of course, much more volatility. But this chart shows us two things. It shows us that yes, it's important to time the market in Bitcoin and it's not just anymore a buy and hold asset, but it also shows us a potential bottom. Those prices at the bottom tend to align pretty well. Bitcoin relative to tech stocks. And obviously, Bitcoin underperformed tech stocks massively recently because AI stocks did well, Bitcoin did not. But it's all a game of opportunity cost. And if tech stocks have already run and Bitcoin has sold off, it's probably not going to sell off as much going forward. Tech stocks are now expensive. Bitcoin in comparison is not. Bitcoin relative to the average cost basis is not yet cheap, but relative to tech stocks, it definitely is. Now in the end, those are all just lines that are drawn in the sand and nobody knows if they will prevail. Still, I think it's a good idea to just take this as a potential measuring stick. If we are low in this trading range, we probably don't want to be completely out of the asset, so out of Bitcoin. And if we are high, we might consider to take some profit. How much potential outperformance is there for Bitcoin versus tech stocks in the near term? Potentially more than 100%. Now this can come in many forms. This could be tech stocks suddenly crashing for whatever reason, maybe because the edge that now the very expensive models by Anthropic and OpenAI gets overthrown by very cheap models from China. So suddenly the business model for those very high-end AI models breaks. That could be one possibility. It could be also geopolitical issues, right? Let's say the production of AI chips suddenly crashes because of a conflict with Taiwan. There are many potential scenarios that could be idiosyncratic to AI stocks going down. If then at the same time Bitcoin just stays where it is because it already has sold off in the last months, that could mean a 100% outperformance. Bitcoin just where it is while tech stocks crash by 50%. I could also be wrong regarding the analysis with the realized price. Maybe this time around we stop the bear market already before we go into net unrealized losses. It's very much possible too. Those models are useful to find a general direction, but they're definitely not perfect either. I don't have a crystal ball either, but I do think it's important to consider the data. The casino also does not know the outcome of a particular game of roulette, but the casino knows that when it plays roulette often enough, that because of the statistical edge, because of the way the game is constructed, that long term it will make money. And that's the same approach over here. If you follow the capital flows, if you consider relative valuations, then I do think we can do better than just buying and holding a single asset or just having a diversified portfolio with static weighting. I think it's better to adjust the weights and own more Bitcoin over here relative to tech stocks and own less of that when we are over here. That's how I manage my capital, and I've been doing quite well with that approach. If it's your first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. Helps the channel grow. Feel free to also check out the premium membership that pops up here on the screen. This is where I share my own trades. This is also where you can co-invest alongside with me. See you next time. Cheers.